Hello everyone, myself Deepak Gupta, logging on this platform of College Dekho Learn on YouTube, and this exclusive channel of ours provides free sessions on various topics of finance and taxation. And today we were taking up the topic overhead variance from management accounting standard costing. So before we move into this word overhead variance, as you all must have known that overheads basically denote the indirect cost of the product. That is a basic thing that you all know. It is a indirect cost with the product. So whenever a business is providing any product to the consumer, whether it's a manufacturer or whether it's a trader, there are primarily two costs, that is the prime cost or the direct cost, which is directly associated with the product physically, for example, direct material, direct labor, or there are indirect costs also known as overheads. This prime cost is primarily of variable character, hence it changes proportionately with the output. But overheads are primarily fixed, but they can also be variable overheads. So in this session, we will primarily stress on fixed overheads variance. So before I come into this word of variance, I just give a brief about the overhead costing, then we will move on to overhead variance because that will help you understand the topic better. So because by default overheads are fixed, so in this session we will focus on the accounting of fixed factory overheads. Now, what actually happens that because they are fixed and they are not directly associated with the product, therefore, to add a proportion of the fixed factory overheads to the prime cost per unit of the product, we developed a system of overhead absorption costing. So this absorption basically denotes that we estimate our fixed overheads for the period for which the accounting is to be performed. That is, we are doing pre-costing where we anticipate how much fixed overheads will be incurred for the concerned period for which cost accounts are to be maintained. So in a way, we do the pre-costing and we estimate our overheads. And we also estimate our output, that during the coming period for which we have estimated the overheads, what will be the tentative output known as the budgeted or the estimated output. So when I use the word estimated, I can cost accounting में उसको मैं बजाय के estimation के budget word use कर सकता हूँ, because estimate is rough, but we believe that the budgeted overheads or the budgeted output are being are being estimated on a logical basis based on the past performance and the future anticipated changes, not to include any contingency. So what we do normally in overhead absorption costing, that we estimate the overheads and the output and we calculate a overhead absorption rate. We calculate a overhead absorption rate. For example, अगर आपको लगता है कि आपके इस 1 month के कॉस्ट अकाउंटिंग पीरियड में, बिकॉज इन कॉस्ट अकाउंटिंग द कॉस्टिंग पीरियड कैन बी एनीथिंग which is normally either week or a month, because in cost accounts we don't anticipate for the long futures because there can always be changes in the cost structure. So there are normally short periods for which the pre-costing is done. So let's presume here it is a period of 1 month and we presume that in the estimated overheads for the month has to be around rupees 5 lakhs, and the company presumes that the approximate output will be 50,000 units. I'm taking round figures. So this overhead absorption rate will be 5 lakhs total overheads to be covered by 50,000 unit, which denotes that rupees 10 per unit is the overhead absorption rate. So what it actually denotes, that whenever the product is actually produced during the month, we can easily estimate its direct material cost based on the basic formula quantity and into rate. We can easily estimate the direct labor cost based on piece rate or time rate system, and we assume that there are no direct expenses. It will denote the prime cost, and on this actual prime cost we add this overhead cost of rupees 10, which has been estimated on a predetermined absorption rate. That is why we say that each cost of the product will absorb rupees 10 as a share of its overheads, which are common for the all, and that will denote the factory cost of the product. Now this absorption rate of rupees 10 which has been charged to the per unit cost is based on estimated or the budgeted overheads and the budgeted output. But what we have failed to notice till now, that the actual after period overheads, that is the overheads which may have been incurred actually during the month, they may or they may not be equal to 5 lakhs. Similarly, what you planned to produce that the budgeted units may not be equal to the actual output because of the differences in the demand. If there is excess demand, then the output could have increased and vice versa also. So they both may not tally with what you anticipated because of reasons which are in the normal course of business. So if we in this example presume that the actual overheads have increased to 5,25,000 rupees because the output has increased by, let's say output has increased by 20,000, or I should say 10%, that is the output is now 5,50,000 units. So what is happening here, that because of the increased output, and though the overheads are fixed and they have nothing to do with the quantum of production, still there is an increase in the overheads because of the reasons which were not planned in the beginning of the month. So what is happening here, that there is a stark difference between the budgeted overheads and the actual overheads, and the overheads, sorry, the output which was budgeted, which was planned, and the actual output. And in addition to this, because you absorbed rupees 10 per unit of the overhead to each output produced, therefore, because the actual output was 5,50,000 units, sorry, it is, sorry, 55,000, because 50,000 is high. So this is actually 55,000 units. एक zero ज़्यादा लग गई, तो 55,000 यूनिट्स, बिकॉज 50,000 से 10% इंक्रीज हुआ तो 55,000 यूनिट्स हुई. Because the actual output was 55,000 units, and in each unit you have absorbed rupees 10 as the overhead cost based on the predetermined rate. Therefore, in cost accounts, rupees 5,50,000 has been charged. So basically, they denotes the overheads which have been absorbed. Clearly speaking, these are the overheads which will have been or which will be charged in the cost account. That is, जब आप मंथ की कॉस्ट शीट बनाएंगे तो वहाँ 5,50,000 ओवरहेड्स डेबिट होंगे. लेकिन अगर आपने कंपनी का प्रॉफिट लॉस अकाउंट बनाया होगा तो वहाँ ये एक्चुअल ओवरहेड्स चार्ज हुए होंगे. और समवन विल से कि ये 5 लाख का क्या यूज है, दिस 5 लाख वाज बेनिफिशियल ओनली टू कैलकुलेट द ओवरहेड एब्जॉर्प्शन रेट. So what we are seeing here, that there is a stark difference in what you budgeted, what you absorbed, and what you actually incurred. And this difference has been primarily due to the budgeted output. So the budgeted output, which was 50,000 units, is not tallying with the actual output, which in this case has increased to 50,000 units, whereas the actual overheads incurred were 5,50,000. The plan was to spend rupees 5 lakh, but on this basis of predetermined absorption rate, we have charged 550 to the cost accounts. So this difference in what you planned, what you incurred, and what you absorbed is basically give rises to the concept of overhead variance. And this overhead variance has to be analyzed for its reasons. And the reasons are obviously primary. The budgeted overheads have changed and the output have changed. So therefore, the reasons have to be analyzed by the nature of the impact on this variance due to the quantum of overheads which have changed or due to the quantum of output this has changed. So conceptually, when we use the word overhead variance, which in this case are fixed overheads, and it does not make a difference whether these fixed overheads are factory, office, or selling overheads. So we presume the concept remains constant for any of the three of the kinds of the overheads. So therefore, this fixed overhead variance is actually the difference between the overheads which have been absorbed, that is, which have been charged to cost accounts, minus the overheads which have been actually incurred. So in this case, we charged in cost accounts 55,000. We incurred in financial actually 525,000, and this 25,000 is denoting the fixed overhead variance. And to analyze the reasons, we are having two factors. One is that there is a difference between the budgeted overheads and actual overheads, and this difference is known as fixed overheads expenditure variance, is known as fixed overheads expenditure variance. And there's a difference in the output, that is what you anticipated was the budgeted output and what you provided was the actual output, and if multiplied by the budgeted overhead absorption rate, then they will denote how they have changed overhead absorption rate. If you multiply this by this, then it denotes the budgeted overheads, and if you multiply this by this, then it denotes the overheads absorbed. So this difference, so we can write this variance, which is known as a fixed overhead volume variance, fixed overhead volume variance, either this way or this way. And if you see clearly these three figures, then there are only three items: budget overheads, and these budget overheads are common, actual overheads, and overheads absorbed. When I started, I said that because there are three different overheads: budgeted overheads, absorbed overheads, and actual overheads, and because of these three figures, we get the concept of overhead variance. So basically, the difference between the three in analyzing way known as expenditure variance and volume variance constitutes the total fixed overhead variance. So you will see here that this fixed overhead variance of 25,000 will be equal to the total of these two variances. For example, in this case, the budgeted overheads were 5 lakhs and the actual overheads were 5,25,000. So this in a way is a negative figure known as adverse variance, and this figure of budgeted overheads and the overheads absorbed is a 50,000 figure, which is basically favorable. So if someone has to learn by the concept of plus or minus, presuming plus as favorable and negative as adverse, then we can shift the formula from budget overheads minus absorbed overheads to overheads absorbed minus budget overheads, because some books show it like this. But actually, this is just a concept which has nothing to do with the plus or minus. Why it is shown adverse here? Because what you planned, the actual overheads were more what you anticipated. So incurring of more overheads will always affect the profit negativity, negatively, sorry. That is why they have been termed as adverse. So basically, if any cost impacts the profits adversely, negatively, then they are termed as adverse variance because they are having an adverse or the negative impact on the profits. So because your actual overheads have increased, that is why it is having a negative impact, that is why it has been termed as adverse. But if you see vice versa, in a way you have provisioned in the form of overheads absorbed, which is 550, whereas you planned it for only 5 lakhs. So in a way, you have anticipated more expenditure. So now, in actual terms, your profit will be more than what you anticipated, and hence it has been termed as favorable. And therefore, this on the same lines is termed as favorable because you made provisions higher. That is why in this formula we wrote overhead absorbed first. That is why if someone is to learn by this concept of plus or minus, they can always change the figures. And if I change it that way now, after discussing the concept, so what we can show it that we will first write overheads absorbed and we will deduct the budgeted overheads from here. So someone is so eager to learn it in the form of a plus or minus, तो ये फिगर 550 होगी, ये फिगर 5 lakhs होगी, and this way this will become favorable and in accordance with how we started with in the original formula. That is why this absorbed was earlier, this absorbed is now again. If you will see here, then you can always see that the fixed overhead variance will be equal to fixed overhead expenditure variance plus fixed overhead volume variance. So this is 25,000 adverse, this is 50,000 favorable, and by the concept of plus or minus, this is the minus, this is plus, hence it becomes 25,000 plus, that is favorable. And in a way we can say that the overheads variance have been verified for their reasons, that how much the variance is affected by the change in the anticipated expenditures and how much by the change in the anticipated output. So we can say that it is hence verified that you have analyzed the reasons of the overhead variance. So I hope this was good for you. Now before closing the session, I just need to make you understand one more thing, that when we calculate this absorption rate, so we have calculated this absorption rate based on the units, that is the budgeted units. But in practical life, the basis on which the overhead absorption rate is calculated can be traditional, and there are 5 different methods based on hourly production and percentage of cost which are used to calculate the absorption rate. And now in the changing scenario, there are various customized absorption rate methods where we identify to link the nature of the overhead with the nature of the activity. And for each industry, we identify the nature of activity affecting the nature of the overhead or a specific overhead. So this customized basis of absorption calculation is nowadays known as activity based costing. And therefore, because of the change in the basis, so we can always add more and more variances to this concept of fixed overhead variance. So for example, when I took only two variables, that is the overhead and the output, then we use the word two-way analysis. Now if in this example I will add now one more variance, that is the hours of the production, then it will become three variable, or we should say three-way analysis, and so on. We can add more and more variables and that will become two-way analysis, three-way analysis, four-way analysis, far-way analysis, and so on. So this more and more variance addition will be discussed at higher levels, but normally at the college graduate level, we only stick to the maximum three-way analysis. So if I adapt that example again to the three-way analysis, so we started with the budgeted overheads as 5 lakh rupees, and budgeted output यानी कि volume to 50,000 units, and we compared them to actual overheads which were 5 lakh, which were 5,25,000 rupees, and actual output, and that is the volume, which was 50,000 units. Now, because there were change in two variances, so it was a two-way analysis. Now, if we now count or anticipate that how much hours of the production will be utilized to produce these 50,000 units, for example, and that hours of production can be counted in terms of the human labor, then it will be known as labor hours, or in the terms of the machine, then we can use the word machine hours. So if in the current time we presume that the machines are more important than the humans, and we count the machine hours and we say that budgeted machine hours are 25,000. So it denote that for 50,000 units we need 25,000 hours. It means we need half hour per unit. So we anticipate that 50,000 units will require 25,000 of machine. But because the actual production has increased from 50,000 to 55,000 here, and that why, because of the increase in the output, the actual machine hours shall also increase. So ideally, because the machine is using half hour per unit, so ideally the machine hours should have been 27,500 hours. That is 55,000 into half hour. But it may not happen. And if we presume that actually 30,000 machine hours were used, so there is a new variable that what the hours ought to be. So we use the word that they denotes the standard hours for actual production. That is, even though the production have increased, but if it could have maintained the original level of efficiency, then it should have been using only 27,500 hours. But because the actual hours were more, that is why it is actually denoting the lack of or the default or the fall in the efficiency levels. So what will happen here, that if I calculate the machine hour rate based on hours, then it could have been or it should have been 5 lakhs divided by 25,000, and that will be rupees 20 per machine hour. And therefore, because of this, if we measure the overheads absorbed, if we measure the overheads absorbed based on machine hours, then the overheads absorbed would have been 30,000 into 20, that is 6 lakhs. So in the earlier case, the fixed overhead variance was equal to fixed overhead expenditure variance plus fixed overhead volume variance. But in this new scenario, it will be equal to fixed overheads efficiency variance. So there is a new variance because the overheads absorbed now will change, and this is what you call that when there is a two-way analysis, then we will have three overhead variances. If we have three-way analysis, that is three variable, then we will have four-way analysis, or I should say, sorry, the four variables, four overhead variances. So I'm again repeating, if there is a two-way analysis, then we'll have three overhead variance. If there is a three-way analysis, that is three variable, then we will have four overheads variances and so on. So this factory overhead efficiency variance will be equal to standard hourly absorption rate, which in this case was 20, and multiplied by the difference of the standard hours for actual production minus actual hours consumed. So in this case, anticipation was rupees 20 per machine hour. The hours that should have been there were 27,500, but the hours actually consumed are 30,000, and therefore this 20 into 2,500, that will be rupees 50,000, and that will be adverse because the increase in the hours will not be counted in a good scenario because that will denote inefficiency. So therefore, we can always have these four kind of variances. So ideally, we use the three-way analysis and there will be these four variances, and the overhead variance now will be calculated based on the absorbed overheads from here, and that will just prove the way it has been proved earlier. So I hope this session was of help to you, and on this note,